welcome to our Dairy Risk Management webinar hosted by Farm Credit East and crop growers. Today we have a timely and valuable discussion on the dairy risk management options that are currently available to producers. The programs that we'll be covering today are the new dairy margin coverage offered by the Farm Service Agency, the recently released Dairy Revenue Protection Program, and the available Livestock Gross Margin Dairy Program offered by the Risk Management Agency. Today we have two very well-known speakers joining us. Both are considered leaders in dairy risk management. Jenifer Dean, who has been with USDA for over 20 years in the roles of County Executive Director and Price Support Specialist for the New York State Farm Service Agency, and responsible for many programs, including the dairy margin coverage, marketing assistance loans, farm storage facility loans, and the 2014 Farm Bill programs, agricultural risk and price loss coverage programs. Most recently, Jenifer has been a member of the National Dairy Margin Coverage Task Force and worked closely with developing the rules for the dairy margin coverage. Our next speaker will be Tristan Peterson. Tristan is a Northeast marketing agent for crop growers and Farm Credit East. He specializes in serving dairy and cash crop producers. Tristan is a graduate from Morrisville College with his bachelor's degree in agricultural business and in 2015, and then began his crop insurance career in 2017. Welcome to both Jenifer and Tristan. Jenifer, we'll start with the Dairy Margin Coverage Program, so welcome. And as Kyle had mentioned, as you have questions, please text them in, and as we've set aside 15 minutes at the end of the presentation for question and answers. Jenifer, we'll turn it over to you.
Thank you, and thanks for having me. Today we're going to cover the program. Sign up does start on this Monday, the 17th, and the federal regs were published yesterday, so our rules are out. And we're going to go over the general rules for DMC now and some payment information. So you're probably all familiar with the MPP program, margin protection, that we had under the last Farm Bill, and it is similar, but we've made quite a few changes, hoping to make it a little more useful to producers. It does offer catastrophic coverage at no cost to producers still, like MPP did, except for the $100 administrative fee that has to be paid at the time of sign up. But we've added some greater coverage levels for this program, also has some for that administrative fee that has to be paid. It provides a payment when the margin falls below a specified level. Well, we get into what the margin is, and we look at the margin as the difference between the all milk price and the average feed cost. They're calculated each month. So for example, if that all milk price, sorry, my screen just died. It's $20 a hundredweight, and we calculate that the feed cost for the same month at $12 a hundredweight, then our margin would be $8. So if you had $9 coverage that month, you'd get $1 per hundredweight payment. If you had $7 coverage that month, you wouldn't get any payment for that month. The difference here now is that we have Tier 1 and Tier 2 premium rates have changed. For anyone not familiar, Tier 1 is the first 5 million pounds of production you choose to insure, and Tier 2 would cover any production above 5 million pounds that you'd like to insure. We have added some new coverage levels for that first 5 million pounds, and we've also changed the percentages you can cover that we're going to get into today. We added a secondary election option now. So historically, when you chose your coverage level for the 5 million pounds, that same coverage level was applicable to anything over 5 million pounds. What we've done under DMC is if you choose the higher levels for your first 5 million, which are 859 and 950, you'll be allowed to pick any level of coverage you want on the stuff above 5 million. So makes it a little more palatable because you could just do the catastrophic level on all your other milk if you wanted to do that, which would be no additional fee. We also added a premium discount option. So if you choose to lock in for all 5 years of the program, so 19 through 23, your premiums will be reduced by 25% for each of those years. One of the good things that has changed, we've all had to keep track of before, is now there is nothing stopping you from participating in multiple insurance programs. So now you can be in DMC on whatever amount of production you want to participate with, and then also participate in LGM or DRP simultaneously if you want to. There's no limitations to that anymore under this Farm Bill. Under MPP, there was an annual bump. So each year you got an annual bump on your production that was in the program. They have done away with that bump. That came under the new law. However, if you've never been in the office and you haven't established your production history yet, you will get a one-time bump of this 1.0186 factor, which is the 2018 bump factor that was set. So everyone else who's already participated in the program will just bring in the production history we've used under the MPP program. And if you have not, then we're going to establish it, and we're going to get into how you would do that. So now one of the changes is the coverage level options. It used to be you could cover anywhere between 25% and 90% under MPP of your production. That limited some of the larger dairies because they were trying to just get down to cover that 5 million pound mark. So now we are going to allow you to insure from 5% up to 95% to help you manage how much you want to insure out of your business. Another change is if you choose to sign up now, you can choose to sign up on an annual basis. You are not locked into the whole Farm Bill if you do not want to be, and then you are not required to pay that $100 administrative fee unless you choose to participate in that given year. So that's under the annual sign up. If you choose that 5-year lock-in to take the 25% reduction in the premiums, then you are locked in for all 5 years, and you would be responsible to pay your $100 admin fee each year for those 5 years, along with any applicable premiums. So the catastrophic level coverage remains at $4. So at that $4 level, that's what you get if you just pay the $100 admin fee and there's no more premium cost to you. The higher levels of coverage we've added under Tier 1, so that first 5 million pounds, is $859 and $950. However, Tier 2, we didn't change those. So any of your production over 5 million pounds will still have a choice of the $4 to $8 coverage. So that new option we're talking about is as long as you pick that $859 or $950 level on the first 5 million pounds, again, you can pick any level you want of coverage on anything over 5 million pounds. So you could just do the catastrophic, which wouldn't cost you any more premium, or you could buy up if you wanted to do that. So here's just a quick shot of what the premium schedules look like under DMC. They have changed quite a bit from MPP. So for Tier 1, they've reduced the premiums by quite a bit. Just for an example, if you look at the $8 coverage level for your first 5 million pounds, under DMC it's 10 cents a hundredweight. Under the old program, it was almost 48 cents a hundredweight. So they have reduced these premiums drastically. Even at the $950 level, you'll see it's 15 cents a hundredweight. And if you were to do that 25% premium lock-in, it actually gets that down to about 11 cents a hundredweight. You'll see under the Tier 2, the 3 non-applicables are for that larger coverage level, and that's because they're not being offered for that. The $850 to $950 is not being offered under the Tier 2. But the premium levels for Tier 2 have went up, so they did not go down like Tier 1 did. So if you choose that 5-year lock-in, that locks you in from 19 through 23. And the key to that lock-in, I'd like everyone to keep in mind, is that if you choose to lock in, you are locking in the same level of coverage for all those 5 years. So if you choose that $950 level, then you are at that $950 level and responsible for those premiums for the life of the Farm Bill. If you do not want to do that, then you can sign up annually. You don't get the 25% reduction in your premiums, but you can change your premium, or you can choose your coverage levels each year as you decide what is best for the business. I just wanted to do a quick slide for dairies who had paid previous premiums between 2014 and 2017. You should have received a letter from your local FSA office by now. We are running currently that we are doing a refund of some of those premiums to producers in many circumstances. The refund is based on what you paid in 2014 through 2017 in premiums versus the payments you received back from the program in those years. So if you haven't received a letter and you think you should have, you can contact your local office and they'll happily look it up for you. If you do have your letter, it should give you those dollar figures. But basically what your choices are is we will take that repayment amount and you can choose to have 50% of that amount given back to you as cash. So there's a form you would fill out at the office and they direct deposit that right into your bank account. Or you can choose 75% of that amount and you can use that as a credit towards your DMC premium. So that'll be kind of done in the background in the software. We'll load that credit amount, and any amount you keep in there will pay on the premiums for the program. If you have more coming in this refund than your premium that's owed for 19, it will just carry over and pay on your 2020 premium, and it would keep going until that credit had been all utilized. So those are your two options you can do with that money. And you do have until September 20th to make that election. That is the same day as the deadline for the DMC program. So on the final day of sign up is the last day you have to decide what you'd like to do with that premium refunds you have coming. So to participate in DMC, you have to have production history established. Most dairy farmers, I think at this point, do have production history established at FSA, but if you do not, that's something we can do for you and with you. The registration period for the new program starts Monday, June 17th, and rolls until September 20th of 2019. To be approved, you have to pay that $100 admin fee. And you'll see I have if applicable there. There are circumstances where you can have that fee waived based on if you are a limited resource producer, a beginning farmer, you fall under the socially disadvantaged rules. The local office will help you with that, and if you qualify, you would sign the form, which is the CCC 860, and we would waive that $100 fee. So you then pick your selection coverage level. So you have between $4 and $9.50 to pick on Tier 1. If you have more than 5 million pounds you want to insure, you can pick between $4 and $8. Remember, if your Tier 1 is that $8.50, $9, or $9.50 level, otherwise it will be the same coverage level as your Tier 1 production. And then you select your coverage percent of how much of your production history you want to insure, which can be anywhere from 5% to 95%. And we're going to do an example here in a bit. To be eligible, you have to produce and commercially market milk from cows in the United States. And federal, state, and local government agencies are not eligible for this program. And again, you can be enrolled in LGM and DRP simultaneously if you would like to be. So production history, we changed all the forms for this program under DMC, so they have some new names. If you have not been in the office yet to establish your production history, you would do that on a CCC 800. If you already have it approved in the system through the MPP program, that was on the 781. And that production will roll right into the DMC software and will be what you will use. You have to submit a completed contract, which they'll help you at the office with, and that's where you pick your levels and if you want to lock in for the life of the farm bill or you just want to do it annually. You'll pay your administrative fee of $100 if applicable, and any premiums for each separate and distinct participating dairy operation. Now, as far as the premiums go, we know for 2019, and I'm going to show you the numbers in a minute, but we know for 19 that the payments for the first 5 million pounds will be higher than the premium due. So what you can do, which we also allowed under MPP, is if you choose to, You can do an assignment, and we will take that premium directly out of the payment we issue you, so you don't have to physically write a check and pay the premium and then wait for your payments. But you absolutely can do that if you want. An assignment is just an option if you'd rather we just took the premium right out. The premiums are due also on September 20th of this year, of 19. The deadlines will be different for future years, but since this is a retro sign-up, we are giving you till September 20th. To be eligible, you also must be a citizen or legal resident of the United States. You have to share in the risk of producing the milk, and you must make commensurate contributions to the dairy. So land, labor, management, equipment, capital. We get into eligible production history, and I just wanted to do a few slides so anyone who hadn't established production history with the agency could see how we do it. Based on the Farm Bill, we consider two different kinds of dairies. You're considered an existing dairy if you were in operation prior to January 1st of 14, and they consider you a new dairy if you started milking after January 1, 14. So that's kind of the two pieces of criteria we look at. If you were in existence before January 1, 14, we will look at 11, 12, and 13 production, whether you have all three of those years or just one. But if you do have any of those years, your highest of those will be used. That is statute that came with the law, so that was not something the agency was allowed to change those years. So that's why we are still using 11, 12, and 13 for those situations. If you started milking after January 1, 2014, this is handled a little bit differently. You can use any annual milk marketings from a full calendar year. So for example, if you started milking in 15 and you were coming in this year, you would have full calendar year of milk marketing for 16, 17, and 18. So then you could pick which of those 3 years production history you want to use for the program. The other situation is if you're a new dairy operations, so you do not have a full year of production history to give us. So if you started in the last year, then you may not have a calendar month. We do have a format we use to figure those. This is the same as it was under the MPP program, where we can either extrapolate your numbers based on using the months you have full marketing, or we use the rolling herd average multiplied by your average herd number at the time of sign up to figure out what number would be your production history, and then you can pick between those two choices. So those are your three options of when you have to establish production history. As you can see from any of them, you need to bring in those milk marketings into the county office with you so they can figure that for you. We're going to get into some numbers here, so I just wanted to make it clear, since this is something that's really new, is again, it's that tier 1, if you select $4 through $8 coverage, then you're anything above 5 million pounds, it has to be the same coverage level. If you select $859 or $950 on your first 5 million, then you can select any coverage level on your above 5 million production between the $4 and $8 available. Same thing here. So just like you to kind of see those numbers, and we'll get into here as a premium calculation. So I think this will be pretty common around this number that an ABC dairy has an approved production history of 5 million pounds. And they want to make a coverage election at that 950 level, covering 95% of their production. So this kind of shows you how we figure that premium first. And this is a non-lock-in, so there's no 25% discount to it. So we take your millions of pounds, or whatever your pounds may be, we multiply it by that 95% that you selected for your coverage level, which means you're insuring that 4,750,000 pounds. We're going to divide that by 100 to get that down to 100 weight, which is how we build premiums. And we're going to multiply that by that level you picked. So as we looked here, at 950, it's 15 cents. So we would multiply that by the 15 cents. So the premium for this year, for this example, would be $7,125. Just for comparison, if you do that exact same situation, but have chosen to lock in for the 5 years, so you get your 25% discount, the premium for year one would be $5,343. So it does make pretty good difference. You're going from $71.25 down to $53.43 for the same level of coverage. The only difference is this is locked in for the 5 years to get that discount. I don't know how many people have heard this yet, but I did see it was published. I think this is great news for the dairy farmers, that as of yesterday, USDA has approved a 50% blend of premium and supreme alfalfa hay prices to use when we're figuring the total feed cost, excuse me, to help more closely align that hay ratio, the hay used by producers. So when these numbers come out yesterday, you're going to see in my example coming up that this has bumped up what the DMC payments will be already. This is retroactive. So January, February, March, and April's rates had been announced. If you looked at them yesterday morning, they're quite a bit higher today than they were then because of this change in how we're going to calculate that feed cost ratio. So great news for farmers as far as the payments will go. I just wanted to give you one example just so you had a sense of how we computed these. And we're continuing this kind of with the same example we started with that 5 million pounds at the 95% at the 950 level. So by the producer picking this 950 level, we know the January margin is 771. That was announced a long time ago. I said if you looked at this yesterday morning, the January margin was 799. So it changed quite a bit using that alfalfa. So since this producer picked the 950 level and the margin announced was 771, that means we're going to pay them $1.79 per hundredweight for that month. And how we do that is pretty basic. We take your 5 million pounds, we're going to multiply it by your coverage level. So in this case, the 95% to get your insured pounds. We're going to divide that by 100 because we do the insurance in hundredweight, which makes the 47,500 hundredweight. And then we divide that by 12 because the DMC payments are made monthly. So we know that each month we make a payment, we're going to make it in this example based on 3,958 hundredweight for this producer. So for January, we take that hundredweight, multiply it by the margin. His January payment is going to be $7,084.82. I think it's important if the producers, you can do this in the office or you can do this at home on your computer, but we do have a DMC tool out that the University of Wisconsin put together for us. I strongly encourage you to go play around in there. I think it's really useful information, so I'm going to give you a few screenshots just to kind of show you what you can look at. But when you go in, first thing you'll see is this forecast graph. The light blue shaded area is the 950 area. So this is all areas that would trigger a payment from FSA. You'll see we already know January, February, Marches, and April. Those have already been announced. And currently, May, June, July, and August, that black line is what the projected price is. But they give you the green and the red to kind of give you a variable because obviously these are projections. They're not set in stone yet. So this kind of will show you what it looks like they are projecting for prices to do and what payments would be. We also have this probability table, does the same thing. It just puts it in a percent. So you can kind of look at that to see what the percent is that may trigger a payment. What's really useful is the select coverage button you'll see up in the right-hand corner of that screen. When you click on that, you can enter your annual production history in the top box. Like I said, if you don't have that, you can call the local office and they will give it to you if you've established it, or they will help you establish it to come up with that number so you have a good idea of what you're looking at here. You would enter that number there, and then you would enter the coverage percentage you're thinking about covering. So to make life simple, we looked at, this is a 10 million pounds production history. Say we only want to cover that 5 million pounds, that tier 1 cheaper level, then we could pick just 50%, so our covered annual production was 5 million pounds. Pick the 950 level for 19. It pops up at the 15 cents, and it shows you at the top exactly what we talked about, that your premium is plus fee of $7,600. So this includes the $100 administrative fee. It also shows you if you took that premium with the 25% discount, what the fee would be for the annual cost. And then it does add it together if you decided to do that, that would lock in for 5 years, how much that fee would, or that premium would be for 5 years. Keep in mind, premiums are due annually. We do not take this amount of money up front. It would be due every September on the due date that's established, September 20th for this year, and then whatever the future years are established. Same thing with the admin fee. Even if you lock in, we're only going to take that $100 once each year for the life of the program. I think it's important to mention, we've talked about how you can pick the different levels at Tier 2 if you've picked 859 or 950 level coverage over here in Tier 1. So I changed our example here to that same 10 million pounds, but we're going to do a coverage level percent of 95%. So this is saying this producer wants to cover 9,500,000 pounds. So we know the first 5 million pounds gets covered over here in this Tier 1. Tier 2, because they selected 950 for Tier 1, they can pick any level they want for the rest of their production. So for the other 4.5 million pounds. You can pick the $4 level here at the bottom. You'll see there's no fee for that. So that gives you catastrophic level coverage on the rest of your milk at no extra cost. But I would like you to see that the $4.50 and the $5 levels are the same prices as Tier 1. So it might be worth deciding with your business if you'd like to up that catastrophic level to $5, the $5 level. In this example, it would only be another $225. Obviously, you can see once we exceed the $5 level, it starts to get pretty expensive. But between $4 and $5 level on that Tier 2 is still pretty reasonable. So it might be something to look at for your operation. There's also a button up in this right-hand corner that's MPP Premium Repayment. We talked about a few minutes ago. If you did get a letter or you think you should have and check with the office, that premium repayment amount you can enter into this box that will pop up, and it will tell you how much you have coming back. So in this case, if you took the cash, it would be $2,500. If you took the credit, it would be $3,750. What I want to point out here is when this tool was made, they don't take into account sequestration, and all of our payments out of FSA right now are being sequestered, so they're reduced by 6.2% for this year. So these amounts, you would not get $2,500 in cash. You would get $2,500 minus the 6.2 in sequestration. But it does show you what your cash out would be, and it does show you what your credit would be and how long that credit would last. So in our example we had in the tool, this $3,750 would pay for over a half a year of premiums annually, or it would pay almost a full year of premiums if you took the 5-year lock-in with a 25% reduction. So this, I think, is the really important screen for 19. We know the triggers already since we're doing a retro sign-up for January, February, March, and April. Before the deadline, we'll know May and June. But as of now, we know these are the margins for those 4 months, and that is with the corrected alfalfa rate. So we know if you take the 950 level on your first 5 million pounds, these are the payment rates for that producer, that dairy operation. And these would be the payments at that 95% level. So like we talked about, even with an annual enrollment in 19, we know the premium is around $7,000. We know the payment's going to be around $19,000 so far. So definitely worth looking at in 2019 of doing as much production as you can under that 5 million pounds at that 950 level, because in hindsight, we have hindsight here, and we know what the payments are going to be coming out. If you choose to insure anything above 5 million, those numbers are going to change because you have premiums involved. So the county office will look at those with you, and they'll go through all those numbers with you to see what is your best case. This is where I discussed, though, that if you do not want to just pay the premium out of pocket, we can take it right from this payment, and you will get the balance of the payment, and FSA would keep the premium. You can contact your local office for any specific information. They're happy to look at your own numbers with you. This is just kind of a general overview for everybody. If you do not know where your local office is, there's a website where you can go to. This one on the screen is an office locator to help you find which one you should contact. And that is the end of my presentation.
Great. Thank you, Jenifer. Thank you for a thorough program overview, and certainly DMC will provide benefits to dairy producers for 2019. We do have several questions from attendees that we will discuss in the question and answer session. At this point, we'll transition to Tristan Peterson. Tristan will cover the recently released Dairy Revenue Protection Program as well as the Livestock Gross Margin Dairy Programs. Tristan, welcome to the webinar.
Thank you. Can you see my screen?
We can.
Perfect. Perfect. Still see it?
We can. Let's see. We might need to show this in a different view. There we go. Perfect. Thanks.
There we go. Yep. All right. So welcome. Thank you for allowing me to present to you guys today. So we'll go through the DRP program and the LGM program. And let's see here. All right. So with both programs, just as we get started here, just like to go through the disclaimer. At the end of the day, the actuarial information is the information that we have to pull all this from. So as this program is a living program, it'll change year to year. So some of the stuff that we're going to go through today, there has been changes made for the 2020 crop year, so it will change moving forward here. So just keep that in mind. And additionally, as you see at the bottom there, we always encourage you as the producer to work with an agent to have them walk you through the program. They're up to date on all this information, so they know what's going on. All right. So as we get started here, so DRP and other programs, as we discussed there a little bit ago, we can use DRP and DMC to cover the same milk at the same time. The only restriction we have is we cannot use Dairy Revenue Protection and LGM for the same milk on the same months. So as we go through the Dairy Revenue Protection Program here, just highlight the key parts of the program. This is a protection that provides protection in the sudden decline in the milk price from quarterly revenue on those milk sales. So as we look at the program, quarterly based insurance program. So we go 3-month intervals based on the calendar year quarters. So January, February, March would be the first quarter throughout the end of the year. As we look at those quarters, this can be purchased up to 5 quarters into the future. So as we sit right now, we are approaching the deadline for the 3rd quarter to sign up for the 3rd quarter of 2019. We can actually insure milk right now through the 3rd quarter of 2020. So the program offers us an opportunity to lock in and secure a milk price pretty far out into the future. The 2 pricing options as we look at the program, we can utilize the price on Class 3 milk or Class 4 milk based on the Chicago Mercantile Exchange. They take that 3-month average to establish that price for the quarter on Class 3 and 4. And additionally, we can use a component-based price. So we're looking at a combination of the milk components, butter, fat, protein, and other solids in those each individual respective quarters. So it's pretty flexible pricing options to allow for each operation to really hone in and individualize the program to fit their operation. You as a producer get to choose how much milk you want to protect in the program during each quarter. So unlike some of the other crop insurance programs, where corn, for example, if you insure 1 acre of corn, you have to insure every acre of corn in the county. With this program, if we only want to put half of our production in for the year or a quarter of our production in for the quarter, then we're allowed to do that with no penalties. Right now, the coverage levels on the price that we're protecting goes from 70% to 95% coverage in 5% increments. Just as a little add-in here, as of the end of June, we're going to drop off the 70 and 75% coverage options. They're only going to have 80 to 95% available. And then one more highlight of the program is it's indexed using a state level milk production for the yield adjustment portion of it, and we'll get into that here in a couple slides. So the program essentially comes down to you as a producer have 5 main decisions to make. The value of the milk that you want to protect. So when we look at this, and you'll see here in a couple slides, when we look at the value of the milk, whether we want to utilize class 3, whether we want to utilize class 4, or if we want to utilize that component price option. The next decision that you as a producer get to make is the amount of milk that you want to cover. So as I stated in the previous slide, you're not required to insure all the milk. We're using to-date milk production numbers. So we're not looking back into the historical numbers for that production figure. We're using what you're projected to make in that quarter. So we can insure up to 100% of that. And then the level of coverage, 70 to 95%, that'll be changing as of the end of June from 70 to 80 to 95%. And then which quarter we want to enroll. So as we look at the quarters, we don't have to do every quarter. We don't have to, if you as a producer saw, you wanted to secure through the end of the year, but say we don't want to do the first quarter of 2020 and we want to do the second quarter instead, we are allowed to do that. You can pick and choose which quarters and when you want to enroll that. And then there's a protection factor also that we'll get into here in a second as well. I'll go through it now. As we look at the protection factor, we can increase the value of the milk that we want to protect. So the value on the first portion, as we look at class 3 and class 4, we can increase that value based on the protection factor. So futures options and the volatility. So how the whole program gets its prices and forecast is based on the Chicago Mercantile Exchange options that are used. So class 3 and class 4 milk. And then as we look at butter, fat, protein, and other solids, we're using the butter, cheese, and dry whey formulas to establish those prices, all off of the futures market. So it's similar to a revenue protection insurance for corn, soybeans, wheat, etc. As we look at the premiums, and you'll see in the example here, premiums higher out or further out tend to be a little higher just because there's more volatility in the marketplace. As we look at the premium for, say, the third quarter of 2019 right now, premium's fairly low. As we look at the second quarter of 2020, that premium increases a little bit just because of the volatility in the marketplace. And it assumes the prices are riskier at further out options. So DRP premium support. So this is a crop insurance program, so it is federally subsidized. As we look at the coverage levels and the subsidy factors here, if you're looking at a 95% coverage, there's a 44% subsidy there. So let's break down and go through a class pricing example. So as we look at this example, we're going to see we're in New York State, the county, Saratoga County. Each county, the prices don't change county to county. They're all the same. So the commodities milk, the effective date. So June 7th was the effective date of this. So this is another really important part of the program, is every day the milk price changes, we get updated pricing. So you can actually secure the futures price for any given day. We have from 4:30 in the afternoon until 9:30 the next morning to secure the price in the futures. As we look at this, we're looking at the third quarter of 2019 on a class price option, a protection factor of 1.0 with 1 million pounds of milk. So as of June 7th, that afternoon, Class 3 closed at $16.96, and Class 4 closed at $17.25. So I always, as I'm doing generic quotes, just throw a 50-50 split in these here to give us a calculated price of $17.10. So with this program, we can ensure 95% of this $17.10. So if we go up here, follow the 95% level, we're setting a floor on our milk price based on Class 3, Class 4 futures as of June 7th for $16.24, meaning if the futures fall below that, we are in an indemnity situation. We're in a claim situation for a cost of 2 cents a hundredweight. So as we look at the close-up quarters, the premium is very low just because there's little volatility. So we're securing this total guarantee number, $162,000 of revenue based on 1 million pounds of milk for a cost of $287. So that's how, as we look at the third quarter of 2019, as of the 7th, now I know prices have actually significantly increased during that quarter. And as an additional note, signups for that quarter, you have to be signed up by Monday morning if you want to enroll in the third quarter of 2019. So then let's look at same scenario, different time frames. So this is actually the second quarter of 2020, same 1 million pounds of milk, everything else is the same. Class 3 closed at $16.47 on the 7th. Class 4 closed at $17.45. Same 50-50 split. We aren't securing quite as high of a price just because where markets are in the first quarter of 2020 right now. So we're looking at $16.96, meaning at a 95% coverage level, we're securing a floor of $16.11. And this is where we see that premium increase just because of the volatility in the marketplace. We're looking at paying 19 cents a hundredweight for that. So during the second quarter of 2020 right now, we can secure $161,000 of guaranteed revenue on 1 million pounds of milk for a cost of $1,900. So that's how a class pricing example would work out. So now let's jump into the component pricing example. Same basic, so everything up here is the same. Besides, we look at over here, we're doing a component price option. We're going third quarter of 2019 on 1 million pounds of milk as of the 7th. So on the 7th, butterfat closed at $2.74. Protein closed at $2.12, and other solids at 17 cents. Now the declared test pounds, so this is a nice part of the policy, is we can match your individual on-farm components within a 275 butterfat to a 50 butterfat, a 325 butterfat to a 50 butterfat, and a 275 protein to a 40 protein. So we can match within those parameters, we can match your on-farm component values to give us a good idea of what the calculated value per hundredweight would be. So in this scenario, on a 40 and a 31, we're looking at a calculated value of $18.55, and we can secure 95% of that price, meaning $17.62 is our guaranteed floor on our components, so our butterfat, protein, and other solids. So just as a side note, and I know it's not in here anywhere, why is that important? As we look at the beginning of 2019, producers were getting paid for butterfat, protein, and other solids. They were getting $2.50 for butterfat, about $1.14 for protein, and about 28 cents for other solids. So as we look at these numbers, obviously we're projecting quite an increase in those values, but we want to be able to protect those values also. So we're setting a $17.62. So our total revenue guarantee is $176,000 for a cost of $500. And then we'll just go through the bottom one real quick. Same basic scenario as we went through in the last one. The only difference is Q2 of 2020. So we're seeing these prices here, $2.55 butterfat, protein at $2.22, other solids at 16 cents on a 4.0 and a 3.1. Means we're looking at a milk price of $18.04. We're setting a floor at 95% of that price of $17.14. So we're guaranteeing $17.14 in our milk check for a cost of 23 cents a hundredweight. So the total guarantee would be $171,000 for a cost of $2,300. So we'll go through the yield adjustment factor here quick. So yield adjustment factor, to be a crop insurance program, we had to have some sort of factor like this in there. What the yield adjustment factor does is it's going to affect an indemnity in a situation where milk price is moving, not where milk production is moving. So a nice, easy way to explain this yield adjustment factor, as I'm sure some of you guys are doing the math right now confused, is this is a revenue policy at the end of the day. So we're looking at total dollars secured. So if we look at this yield adjustment factor and the state or pooled production region was expected 5,000 pounds per quarter per cow. So if that was the expected production during the quarter, if the state production comes in above that, so meaning instead of 5,000, we see 5,100. If it comes in above that, they're going to say that since this is a revenue policy, in theory, you as a producer made more milk, meaning you got paid more in your milk check. So they're going to adjust an indemnity and decrease it. So as we see here, any above one will decrease. That's because we made more actual milk, in theory, based on the state production. We made more milk, so we got paid more money. And the opposite's true also. So if we set the expected at 5,000, or if the expected set at 5,000, and it comes in at 4,900, that means you as a producer, in theory, in New York State, made less milk, so they're going to increase an indemnity. So we see below one will increase an indemnity. So some requirements within the policy, as we're looking at the total pounds of milk, so we saw in those examples we were insuring 1 million pounds of milk. To insure that 1 million pounds of milk at the end of that quarter, we have to provide records that we produced and shipped, marketed, 85% of the amount that we insured. So if we insured 1 million pounds, that's 850,000 pounds of milk that we would have to provide records for. Additionally, if we're using the component value option, we have to provide records to meet 90% of those component levels that we insure. So nice, easy round numbers. If we're insuring a 4.0 and a 3.0 for our butterfat and protein, we have to provide records for a 3.6 on our butterfat and a 2.7 on our protein. So let's run through a quick indemnity example as we get near the end of the DRP. So in April, producers got paid $2.54 for butterfat. Our protein was $1.99, and our other solids was 19 cents. Now I'm going to use the same scenario that we used in the pricing example of a 4.0 and a 3.1. So if we multiply these figures across to give us this price over here, that means we got paid in April on a 4.0 and a 3.1 $17.40 a hundredweight. Now, if we just look at that example where we were insuring the third quarter of 2019, on a 4.0 and a 3.1, these were our prices we were looking at, meaning we were looking at $18.55 that we were insuring for the calculated value. Now we take that 95% coverage level of $17.62. So this is our guaranteed floor. We're guaranteed this. So we take that $17.62 and let's subtract out April's milk, just as an example, what we got paid in April, $17.40. That means producers would have gotten paid, if this was the scenario, 22 cents a hundredweight. So if we use that 1,000,000 pounds of milk, we multiply our 22 cents by 10,000 hundredweights to give us $2,200. And if we subtract out our premium of the $493, that's a check back to producer for $1,707. So that's kind of how, if we look at an indemnity example or an example of how producers would get paid, this is kind of how it would break down. So what's covered with the program, as we've discussed, the main coverage of the program is that actual revenue floor, that guarantee, the dollar values. What's not covered is death or loss of cattle or anything along those lines. We're just looking at securing the actual price. So that's a quick general summary of the Dairy Revenue Protection Program. I do want to hit on LGM quick as we wrap up the presentation here. So LGM is another option available to dairy producers through a licensed crop insurance agent. So as we look at LGM, we're looking at milk revenue, so the CME Class 3 price. We're looking at feed cost, so we're looking at corn and soybean meal. We're taking the gross margin, so the Class 3 price minus the feed cost, and then we've got a deductible in there. So we'll run through that. How does LGM work? The Class 3 milk price, you as a producer choose the amount of milk you want to insure. So up to 240,000 hundredweights, that was the maximum, no longer is. As of the 1st of July, that's getting pulled, so you can enroll as much as you'd like. Producers choose the months to insure out of that 10-month period that we're locking in, and a producer chooses a deductible. So a key note, and I was going to touch on this on the DRP portion and did not, is we're not looking at the actual mailbox price in either of these programs. So when we look at these programs, typically in the Northeast, as I've worked with a lot of producers here in the past couple months, we tend to see a little bit greater mailbox price just because of the utilization of the fluid milk that we have in the Northeast. So that's a key component to keep in mind, is when we break these down, we're breaking down the portions of just the Class 3 or those component portions. And then we look at the feed values. So a key takeaway is we're using national feed values, so this is going to vary significantly from what Northeast producers actually feed. We're looking at the corn and soybean on those. So let's run through the gross margin guarantee. So the Class 3 milk price is $16.50, and we take our corn and soybean meal of $2.50 out of that price, and then we take our 50-cent deductible out, meaning our gross margin guarantee was $13.50. So then we go to the actual gross margin. So this is at the end of that time period. Class 3 milk came in at $14.50. Corn and soybean meal was $3, meaning our actual gross margin was $11.50. So then we go through that example of we guaranteed $13.50. We came in at $11.50. That means the indemnity is going to be $2 per hundredweight. Take out the estimated premium of 32 cents a hundredweight. We're looking at a net indemnity of $1.68. So that was with a 50-cent deductible. So as we wrap up with the presentation portion, in summary, DRP creates a floor on the milk price. We're looking to establish that floor to either lock in a potential profit or limit any loss as we look at months further out. Another key takeaway is each individual knowing your cost of production. As you work with an agent to sit down and go through these numbers, knowing your cost of production really helps to establish the best plan that we can offer to protect each operation the way that they need to be protected. And then with premium support of the programs, it's made it really cost effective to ensure and set the milk price to limit any potential volatility that we have in that milk market. So as we look at our call to action, develop a relationship with an agent that understands the business. Work with somebody that can sit down at the kitchen table and help run these numbers and establish that plan to have some sort of risk management in each operation. As we're looking into the end of the 2019 crop year, beginning of the 2020 crop year, establishing that application for DRP. That way, when the time comes and you're ready to endorse milk, it can be done quickly. And then no premium attaches with an application. So once you've established that application, it gives you access to some online tools to be able to run some quotes and really kind of play with the program and see what everything's all about. And I think the most important one as we wrap up is setting the target price. If you as a producer know what your operation, what it takes to, at the end of the day, secure that operation, set a floor on the milk price, be able to make it through each 3-month period, each quarter, setting that target price and knowing when's time to take action, when's time to call an agent and say, yep, it's time to enroll some milk. We know we're either securing a profit or we have fear that milk price is going down. So as we wrap up, I just want to say thank you for the opportunity to let me talk to you guys today and looking forward to any questions.
Great. Thank you, Tristan. And we'll move right into the question and answer section out of the respect for everyone's time. So couple questions that we have, and Jenifer, a few of these we'll start right with you. And one is, what happens if a farm locks in coverage and then goes out of business within the 5-year period, or 5-year time frame?
So if you lock in coverage and dissolve your dairy operation, then the only premium you would owe is prorated for that year, the last year you were in operation, for the days you were actually commercially marketing milk, and the rest would be waived going forward.
Thank you, Jenifer. The next question for you, specific to DMC, is can you confirm that organic producers are eligible for the dairy margin coverage?
Yes, there is no policy not allowing them to participate, so they would be as eligible as anyone else.
Great. Thank you. Next question is regarding timing of dairy margin coverage payments. And I think there might be 2 parts to this, which is really good to know. So one is the retroactive payments. When will those be issued?
So we're hopeful, and I'm going to use the word hopeful, that the January, February, March, April, that group of payments will get issued in July. But I am saying hopeful. We're working on the software to issue those payments, and that's the plan, but I cannot guarantee that's going to happen, but that is what we're hoping.
Okay, thank you, Jenifer. The follow-up, which plays in well here, is once the margins are known, how frequently will payments be made? So we know retroactive, but going forward, when a margin is released and a payment is due, when can a producer expect to be paid from that announcement?
Sure. So if the contract is all approved and enrolled in the system, that should be no different than MPP was, where usually within 3 days we have the amount loaded and the payment getting sent to direct deposit.
Great. Okay. Thank you. Next question is about production history. So we're staying right on dairy margin coverage. And the question is regarding why we can't use a more recent milk production when there might be a significant difference between most recent year's production and the years that are currently being evaluated for what can be enrolled in the program.
Sure, that's a really popular question, and I get it. We can't change it because that's the law. So as an agency, we didn't have the opportunity to let that update years. The law that came from Congress said you will use 11, 12, and 13. I will say that it kind of runs concurrently with our, what is the ARC PLC. It has been the crop programs for years. Those bases haven't been able to be updated since the late 80s. So I don't know why, and it's not anything that would be something to discuss with your congressman if you'd like the law changed, but USDA cannot change that. So that is just the way it is at this time.
Thank you, Jenifer. Switching gears, I know we're just over noon here, but I do have a couple more questions specific to dairy revenue protection. So Tristan, question that came forward, really good one on how do you recommend farmers stay on top of learning about the daily price, especially if they aren't internet users. So what tools and recommendations do you have for producers to stay on top of the Dairy Revenue Protection Program daily pricing?
Yep, so I think, being able to work with an agent and establish a plan is huge. Having the opportunity to work with producers and set those prices and watch those prices, that's a key takeaway with that, and keeping an eye on those prices, just working with that agent to do that.
Makes sense. Yep. The last question on looks like DRP is, how do you recommend farmers in the Northeast, specific question here asking state of Maine, but this does apply to all the Northeast, choose between the class or component option regarding DRP and which option to enroll in?
Yep, and that's a really important question and a really good one to look at. When I work with producers, we tend to look at that actual milk check and how each producer is getting paid. As we look at components and class 3 and class 4 prices, all derived from the same essential price, just different formulas going into them. So being able to pull that milk check out and have that one-on-one conversation with producers, what's going to affect them the most? What market movement's going to affect them the most on their operation? Typically in the Northeast, we see that being the component price option, just because that's how producers in the Northeast get paid, is based on butter, fat, protein, and other solids.
Okay, thank you. I do have one question on livestock gross margin dairy, and the question is, in what situation would you choose to use livestock gross margin dairy over the Dairy Revenue Protection Program?
Yep, really, really important question, and a really timely question as we look at the struggles that we're facing, not only in the Northeast getting feed in the ground, but nationally. So as we look at LGM over dairy revenue protection, it's really where we see the potential for more volatility in that feed price. LGM being the margin-based program, feed inputs are a big influencer. And with the struggle we're seeing right now with current planting conditions, knowing and having an idea of where feed prices are now and what the forecast for those feed prices are, I think that's a really important consideration at this moment in time.
Good. perspective. Certainly, dairy producers have quality risk management options to protect market and margin-based risk. So where we are today as we look at dairy risk management, this is certainly an important time in the industry, an important time within USDA as many options that weren't available in recent years. Producers, it seems as though, are in a much better position regarding the available programs, and it really does come down to these type of webinars, educational efforts. So I want to thank Jenifer Dean, Tristan Peterson, and Farm Credit East for hosting this session. It will be posted on our Farm Credit East webinar site. And I'll actually, Chris or Kyle, any final thoughts on your part?
No, thanks for moderating, Jeremy, and I think we had a good presentation. That's, and thank everyone for joining us.